Welcome everyone to the Trade Signal Reveal, Edgefinder Trade Signal Reveal. We're going to get right to it. I got an interesting signal for you tonight. Actually several, but I'm going to feature just one of them. So let me just share my screen here, and here it is. Sell the USD Canadian dollar pair short, looking for a 26 pip target if you get it above the price 1.30 or 1.3602. Here's the chart. Okay, so what it is there's a zone of short entry anywhere up in there. If you, you can see the price has just kind of been going flat, but if it gets up a little bit, short it, because at least for 26 pips, you can get that drop pretty reliably. And when I say reliably, I mean this particular trade came from my Forex intraday solutions, and it's right here. And this is the solution. This is what this particular trade setup is. So what Edgefinder does is it creates a set of rules, backtests them for 20 years, then trades them forward in real time for 20 years, or for 2 years, sorry, and then we get the statistics as a result of that. So here's the in-sample statistics. The ones we really care about are the out-of-sample stats. This trade has an average reward-to-risk ratio of 0.2. What that means is if you lose, you lose, 5, like in this case, 100 pips. If you win, then you win 20 pips. So that thing you should win 80% of the time. This thing, it wins 96% of the time. Crazy good win rate. So you look at this, you're like, well, I'm going to risk 100 pips. But if you could win 96% of the time, you might like it, right? Now that 96%, that's the out of sample. That's what it did over the past 2 years. See, look, here's a little heat map of the stuff on the left. That's the past 20 years. It hardly ever loses. And then here in the past 2 years, same thing. In the past 2 years, this particular solution has only yielded 4 losses. And we just had one 4 setups ago, so we're probably pretty good for a while, right? It goes on long winning streaks. Well, the other stats about it that are of interest are that the gain, or the best trade, made 1.28%. But this is Forex, where everything is leveraged. So, it's not like you're only going to make 1.28% out of it. If you're leveraging on Forex, then, you're going to, make lots more. But average win is 0.2% of the Forex currency price. Okay, anyway, those are the stats that entry rate on this, I should point this one out, is 46.5%, which means just a little less than half of the time will the conditions of the trade actually fire off in such a way that it actually fills. And you see that here. Price is clear down here. In the next few hours, this is a 1 hour chart, by the way, right? Hourly chart. So in the next few hours, this thing would have to go up. But hey, London Open could spring that price up, and you'd be looking for it to drop down 96% historic rate of wins if you're to follow these rules. Short anywhere up in here and try to get a 26 pip target out of it. That's the kind of thing Edgefinder does. And I've been using this tool, Edgefinder, to create a bunch of solutions for a specific set of stocks to take advantage of this, the market's big gamble. Okay, here's what I mean. Recently, about 3-4 weeks ago, the options market makers began issuing options for sale on the Mag 7 stocks, Google, Apple, Microsoft, not NVIDIA for some reason, not NVIDIA. And NVIDIA certainly trades liquid enough, But hey, NVIDIA has weeklies, so you can do this on a Friday. I actually watch NVIDIA on Fridays for this same thing. I have a solution developed to throw NVIDIA signals that I use on Friday. But meanwhile, here's what I'm talking about. Those big stocks that have a lot of options traded, they now have expirations on Mondays, Wednesdays, and Fridays. Trading on the last day of expiration sounds like a pretty bad idea because, either you get in and you just got to exercise the stock the next day. So you're buying it. Why even bother, right? It's not that at all. That's not what we're after. If you're into options trading, then you understand this. If you're not, this thing might be kind of new to you, but I think you'll be interested when you hear some of these details. So here's what happens. First off, let me explain what this term gamma means. Option traders know that there are these things called option Greeks. They're Greek alphabet names of variables. Variables that are part of a complicated Nobel Prize winning equation, Black-Scholes, Merton 2. Okay, there you go, you geeks, you option geeks that need that. Gamma is one of the variables that measures the acceleration. So some of the variables measure, how quickly prices will change, how sensitive they are based on things like interest rates, volatility, or whatever. Gamma is how quickly will the price sensitivity accelerate? How quickly will it change? In calculus, for you math geeks, you learn about momentum and the differential equation, right? Well, gamma is kind of that same, measuring that same phenomenon, the rapid, the rate of increase, right? And for the rest of us who are not calculus math geeks, it goes like this. Higher gamma means more rapid change. That's all. There are three conditions that create gamma. And if you have high gamma scores on the last day of expiration, then you have a really interesting trading phenomenon. So the first one is the closer you get to expiration, the higher the gamma. All right? Easy that. But the other one is if you are closer to the price of the stock. So say a stock like Google is trading at $310. Well, the strike price of the option, if you change that to be 300 or 320, then the gamma is not as high as if you go right at 310. So you try to find the option that is closest to the price. That has the highest gamma. The last one is within the day, the later in the day makes a difference. Earlier in the day, you have pretty high gamma scores, up in the low teens. And that's super high for a gamma score because usually it's under 10 or 1.1 for most days, well leading up to 45 days, 30 days, whatever. All the time, you're never going to see a gamma above 0.1 or 10 cents, in other words. On the last day, on the 0 days to expiration, the last day of expiration, gamma starts above 10, typically, and then it gets as high as 30 in those last couple hours. And it really starts accelerating just in the last 2 hours, 2.5 hours of the day. Now, how much difference does that make, right? Well, I'm going to show you. If you have a 0 DTE option, it's expiring today, whatever day you're trading, and you're working with the at-the-money strikes, and you're working in the last 2 hours of the day, I'm telling you, there is extreme opportunity. Let me explain. Here in Google, this was back on February 18th. I captured this during a time where I actually made this trade. Yeah. So what happens is price just kind of meanders around. Here's on this day, Google's just going back and forth. It hits lows at 301.5. It hits highs at 304.5 or 305, even right here on this little tip. And that move, I mean, you look at that, right? It's just like $3 move on a $300 stock. It's 1% from highs to lows. It's for an individual stock, that's not a crazy volatile day. And here, right at the very end of the day, just in the last half hour, look at this move. We go from 301 and a half, a little higher than 301 and a half, up to 303 and a half, a $2 move. So that's just about 2/3%, a little more than 0.5%. If in fact you were to have bought the 305 call that expires on March 20, I mean, that's more of a typical thing. People buy an option, they want to buy enough time to be right to make it work in their favor. And then what they would see is for that tiny little move, you could, that 1.5% change, you could get a 10% change in the price of the option, go from 950 to 1050. Oh, that's not bad. Leverage 1.5%, just normal breathing in and out for the stock, into a 10% change in the price of your option. Yeah, that's what attracts people to option trading, is the way this leverage creates these big moves. But in zero DTE, if you were to have looked at the 302 and a half, because that was closer to the price, 302 and a half call, which expired on that same day, February 18th, right here. These are literally the moments of expiration. That thing went from 5 cents all the way up to $1.50 and then closed back down at 70 cents. That was a 1,200% change that it ended up taking, over a 1,200% change through that period. While Google was just simply, readjusting at the end of the day, 1,200%. As I mentioned, I bought this. I didn't buy it at 5 at the low, but I did buy it at 7. And when it got all the way up here into, this high price, I actually managed to sell it at 67 cents. I didn't get, the 70, or certainly not the, $1.50 the top, because you never know where the top is. But I did manage to sell it for 67 cents. I mean, from 7 to 67, almost 10 times as much. Yeah, you can bet I was excited. That's the extreme opportunity that tends to happen. This is true for both calls and puts, right? Here's IWM at a day more recently here. IWM is the stock, the ETF that tracks the Russell 2000. Early in the day, it dropped $1.50 and then went back up, and it dropped $1.30, a little, just like the next hour. If you look at the put options that were at the money, right there at 262 and a half, 262, that sort of thing. I think they were 262 and a half. Anyway, it goes up 150%. That's pretty good. Then it goes up 110%. Then there's this one that moves down $1.20, less than these other two moves, but it's later in the day. And this option price goes from 25 cents to $1.20. Pretty crazy, huh? So this is a 5 times increase from low to high, but you can actually figure that if, from the time it made this $1.20 downward move, this thing made a 230% increase. 230% increase compared to 150 and 110. That shows you the difference between early in the day and late in the day. It's late in the day. Well, it used to be that you have to wait around and once a month for options to expire. Then came weeklies, and so you could trade this kind of stuff once every week. Now you can trade it, 5 times a week, because you've got at least 3 ETFs that have zero DTE options every single day. The new thing, though, is that these Mag 7 stocks, they're not indexes. They're not SPY and QQQ, which are an aggregate of a bunch of stocks and tend to move with less volatility than an individual stock. Individual stocks, they can all of a sudden make a $2 or $3 move just out of nowhere. No news, no nothing, and boom, up they go. What do you think the zero DTE options are going to do on days when that happens, right? Tomorrow I'm going to trade live. I've done this twice already, 2 weeks in a row. I've got on and showed some trade setups. I'm only there for about an hour, so I'm showing you the setups. If one happens while I'm there, great, I'll make the trade. But I want to show you the trade I made yesterday. If I can figure out how to get the right chart in the right place. Hang on a second. I think I think you'll appreciate this. Yeah, actually, it was both Monday and yeah. Let me show you Monday first. Monday and yesterday both had fantastic trade setups. So check these ones out. What I do is I use something similar to what I was talking about earlier, where there's a zone, right? Entry zone. But for here, this is not the entry zone. This is the don't trade zone, okay? This is the way I figure out where the price is going to head to. So, in other words, if it opens, whatever it's going to do, it's eventually going to drift towards the dead zone. It's not 100%. It doesn't happen all the time. Seems to happen more often than it doesn't, though. And then what I look for are places where the price pulls back to an extreme. So if it's going up like this, I'm looking for a long. I'm looking for these lines here. They're lines I created using Keltner channels of a certain number and set. Anyway, they measure the average true range, the size of the candles. So I know, hey, if price comes down here, that's unusual. That might be a little too far. It's likely to snap back. Look how good that signal is. On Monday, I actually bought this right here and managed to buy a call option, and then the target was right there. And look at this move. It goes up and then just rockets up much higher. This was fun because I risked about $250 on this trade. In other words, if I bought it and it went straight down and I just got zero, about $250. As it was, I ended up making $1,200 from this run up. Now, I did not hold on all the way up to the top because I could have probably made a couple $1,000s more. But once I hit this $2.38 target, then I start trying to figure out, okay, where should I take the profits? Where should I go ahead and just get out of the trade rather than wait till the end? Yeah, sure, it could keep going up. It could also it could also go against me. Once I have that target amount from whatever starting point I have, then I just sort of bring my stop loss up tight, and if it takes me out, I'm good for it. It's amazing how often I get a big winner out of this kind of situation. You would think that thing just comes around once in a while. Not so. Here's what happened just yesterday, or actually today. This was earlier today. The other one was yesterday. So here's today. IWM is priced up above the dead zone, and I'm looking for the place where this kind of squeezes down, makes that little bump. I extend that out. If in fact price should get above it, then I take this trade. This right here, when the price was up at this level, up above the line, then this 257 puts, the first one out of the money, was only 55 cents. By the time it hit the target, it was just right there. It was a really quick target, and it hit the target, and it was $1.30. So you can see that was like more than double in just, this is a 5-minute chart. So it wasn't even an hour, and it had doubled in value. But had I held on all the way to the end of the day, the price closed at 325 or around 3. That's what I would have had to get out with, 325. So of course that trade could have done even better. This is a fun setup that creates these kinds of trades. And today I could only trade IWM, so I couldn't trade other individual stocks. Yesterday, however, I traded not only ETFs but also Microsoft. Right here was the Microsoft trade I took. Look at this. At 407.50, or sorry, right here at this level with this bump, then I was able to get the 407.50 call at 27 cents. This one took a long time, but all of a sudden the market shot up at the end of the day, to the extent that at the end of the day, that 27 was worth $2.36, about 9 times greater than what I paid for it. Isn't that amazing? I mean, I was thinking, oh, this trade's not going to win. It's gonna lose it, and then kaboom, up it goes. That's just an example of the kind of thing that you can see live when you watch me trade in the Gamma experiment. It's an experiment because I'm trying to see whether or not I can take advantage of the market makers' pricing algorithms. See, they're not used to offering stocks, individual stocks, zero DTEs on Microsoft and Google and so forth. And so the biggest vulnerability, I mean, they got great math, they got great computers, they've been in the biz a long time. That's going to be cool for them to expect to make money, right? But their vulnerability, their greatest vulnerability, and they know this, is that last couple hours of the day, and it runs up. So I'm experimenting. Can I take advantage of that? Now, I have developed a course, not specifically on option trading, but on trading in general. And these are the things you need to know in order to be able to then take advantage of stuff like this, the Gamma experiment and so forth. So I'm pretty excited because we're getting ready to offer it on Quasar Markets. It's going to be available. It's really good. I've been coaching individual students and being an individual trader myself for the past 20 years. And so I've learned better and better ways to teach people to become productive traders as quickly as possible. In this course, I will have opportunity to show you the ability to how you can figure out your own style of trading, how you can figure out your rules that you want to follow. And then I've got interviews with people who have done it, who have become professional day traders. They trade out of their home, or they're part of a team, work in an office. And on Wednesdays, when you come and watch the Gamma experiment, this is free. This is a free trading room that I'm doing. I'm only going to be doing it for a few weeks to just find out whether or not we can actually do this going forward. And we'll be able to have chat rooms, and I'll be able to talk with you guys directly as we're making the trade, so you can make sure that you understand what I'm talking about. You want to show up tomorrow, 2 p.m. Eastern time, here on Quasar Markets. Look for that Gamma experiment. Here's what I did the first week with these trades, plus 5%. Not all of them won, but there was this huge winner I had right here. Just the kind of stuff I'm talking about. When I lose, I can only lose as much as I put into risk. But when I win, the wins, sometimes they're small, but then sometimes they're very big. And anyway, it's pretty exciting. We're going to continue this experiment tomorrow. You can connect with me on X or LinkedIn, or on Instagram, or on TradingView. All of them. My handle is Gordon Scott CMT. And I look forward to having you join in, watching the Gamma experiment, and check out the course when it becomes available. Till next time, everybody, take care and trade well.